Hello and good morning to another episode of Securities Lending Live with Pierpoint. So thanks very much for joining us this week. The objectives of these events is really just to discuss relevant topics and issues. And really for me, I think the key thing is it gives everyone in the audience a chance to participate. So many of us have spoken at conferences, on panels, or as guest speakers or moderators. But look, the reality is what virtual world gives us is the opportunity for everyone to engage. So although you can get questions from the audience and people raising their hands and hoping the moderator sees you, the reality is you have the chance to ask questions here. So we had quite a lot of engagement last week. We had about 19 different messages throughout last week's event. So I want to encourage the same. I want to welcome everyone that's watching, but also everyone that's on watching the replay. So that's really important here because this lives on for better or worse. As with all live events, you get some good moments, you get some interesting moments. My first one turned into a bit of a blooper reel material event, so you'll see that at some point. So I encourage you all to put comments into the chat. There is a slight delay from when you put comments into the chat until we actually see them, so it's never immediate. We will get to everything either in the live discussion or afterwards. We'll actually go back and comment on everything, and we'll carry forward questions. In a minute, I'm going to ask the panelists to introduce themselves. But just as a recap, this is a series of events which will be me and my Pierpoint colleagues. We'll have guests like we have Julian today, but he also counts as a collaborator. So I'm not certain if he's really a guest. He's welcome.
Thanks, Roy.
You're welcome like a guest, but I don't know if you're really a guest. But we will have guests in future. Last week was a much more wide-ranging topic, but generally we will have a mixture of generalist subjects, but also specific topics like today, which we'll come back to in a minute. So if I can maybe ask people to introduce themselves. John, if we start with you.
Yes, good morning, everybody, or good afternoon if you're still in Asia, or if you're still awake in Asia. John Anderson, I'm consultancy lead for Pierpoint Financial Consulting. Prior to that, I'd spent all of my career pretty much last 30 years working, managing various agency lending businesses for a number of organizations.
Thanks, John. Jeroen?
Hi, good morning and good afternoon, wherever you are. My name is Jeroen Bakker. I'm the Benelux consulting lead for Pierpoint. Same as John and Roy, I've been in my entire career in the securities finance world, both on the buy and on the sell side, and now residing back in Amsterdam after 10 years in London.
Thanks, Jeroen. And Julian, over to you, our special guest.
Thanks, Roy. Hi, everybody. Thank you for joining us today. So my name is Julian Eyre, and I've been collaborating with Roy and the Pierpoint team for the past couple of months. And the focus has been very much looking at digitization, opportunities to drive digital transformation in securities finance. My background most recently has been focused on SFPR, the regulation, the test pack, and building up a community collaborative model to mutualize costs and converge towards standardization. I look forward to the conversation today.
Good, man. Thanks very much for that. Apologies, we've had a few sound issues, which hopefully we are in the midst of resolving, but that's also part of the fun of live. Dealing with things on the fly. Just want to say good morning to a few people that have actually signed on. Morris, Lee, Sean. Sean, good to connect with you yesterday. And Manny, who probably I've known possibly as long as anyone else on this panel. But good to see you all here. Thanks very much for joining. We have the weekly contest between the Netherlands and Kent. But I don't see that challenge actually manifesting itself yet. So
come on, Holland.
There you go. There's a bit of this sort of that's from the orange corner. I said last week, as I said, we're general. This week it's about the Common Domain Model, or CDM. It's hot on the heels of the ISLA Showcase last week, which featured a really specific use case. I think it was really the right way to approach it, to say, let's take a real transaction and go from beginning to end. So it was a collaboration with Regnosis and Equilend, FIS and Pirum, and also quite a good introduction, I thought, from Ian at ISTA. So a great session, and that was really the impetus for us saying, let's keep the momentum going. Let's keep people talking about it. Really, from my point of view, I'm going to give you a little bit of context, then I'll hand it over to John, who'll do a little bit of kind of past, present, future, and the challenges for the industry. Then we want to get it to be really real, and I'm going to hand over to Jeroen and talk about real business issues. And then Julian, who described his expertise and his experience over the last few years, he'll lead us through a lot of these technical issues. And promote conversation. So really ask questions all the way throughout. I'll take them as appropriate, and we will get to them. But look, let me just start it off by saying, for me, change is constant. One of the things I keep hearing about with CDM is, we've just got through SFTR. The last thing we need is another change. We have to get back to business. And I really understand that, because it's not just SFTR. This decade has really been driven by regulatory initiatives that have often diverted us from business, and we're all in this game for business. But when I look at change, if I just I listed off 57 different change items that I've had in my 100-year career. But I wanted to pull out some key themes here. One was when I was at the depository in Canada, I was there for 3.5 years. And when I joined, every single settlement was in physical securities. Some of the cash settlements were netted at the depository through our clearing center. But there were many certified checks that flew back and forth. Yeah, you had to go to part of the messenger's run, which was what my first job was to go deliver securities, pick up checks, or deliver checks and pick up securities. So in 3.5 years, we went from a fully certificated market to the beginnings of book entry, through to the first new issue that only ever went into a book entry system and was represented by one jumbo certificate. So that was in the space of 3.5 years. When I was at a product manager for a custodian bank in Canada, DTC was going to online affirmation. So if you didn't affirm your trades by T+2, I think it was, you actually got on their bad list. You got on the naughty list, and they actually published who was underperforming, who was below the 60% affirmation target level. And so there was a need for everyone to do. So we brought in the first online connection into Canada for customers to affirm trades. And the whole concept was new, that they had to get involved and actually take action on their trade. They thought, my instruction to you is plenty. That was also the bank where I was the first test case for the first PC that was implemented there. I signed up the first customer for one of the largest U.S. banks, a first non-U.S. lending client into their program. The first one. I mean, can you imagine? Like, who thinks of, there's U.S. clients and then there's the rest of the world? There's just a universe of lenders. I went at one of my firms. I was the first person in the front office in securities lending at Nomura. And 5 years later, when I left, not only had the team filled up, but we also had launched prime brokerage. That was in 5 years. We went from not even having someone in the front office to having a full-blown operation. If you look at my last job, I was given the challenge of transforming an agent lender's technology, business, and we did it through technology. And what we did was we leveraged NGT and trading apps. And in a single year, we went from 12% STP, from pre-trade, trade execution, instruction, and settlement, from 12% to over 70% in a year. And it would have been higher except all of the static data people at borrower counterparties that we needed to code up our business were distracted by UMR, which was a much bigger priority for them. Otherwise, the figures could have been higher. And so I give you all of these examples because, well, partly because I needed to fill the time. No. But the reason I'm giving you that is those are all examples of business initiatives that required upfront technology investment. But in every one of them, we had a clear view what the payback would be. And also, none of those was transformational. If in that last job I'd said, well, there's no point in us automating trade execution until we hit 80% of our counterparties with their accounts coded up correctly, we would never have got it off the ground. We would never have benefited from that dramatic growth to go from effectively doubling our transaction volume with the same flat headcount, right? So I think that's the same. I think the problem when people look at SFTR regulatory initiatives, even they now are being rolled out, right? Not everything went live on day one. And the same thing I think we need to apply to CDM. So what's the business reason for doing it? When's the payback going to be? And are there steps along the way that give us incremental payback because the fully blown, wide and deep integration into our systems, if we wait for that, it will never happen. I guarantee you that will never happen. We will never go transformational overnight from nothing to everything. And even for these sort of short-term changes, the other issue I keep hearing people say is, well, yeah, but we need everyone to be on it. And I don't think you need everyone to on it. Not everyone was on Equilend day one. Not everyone used Pyram or Equilend for post-trade reconciliations day one. The service offerings of any of the vendors in the system today aren't what they were when they launched. And so I think the test here for CDM and its application is, what's the need? What are small bite-sized pieces that give us payback? If we get payback, does that give us then the incentive to go forward? And we're talking about a transition. This is a global business, and people deal with counterparties in many, many, many different countries. And it's unrealistic to think that everyone is going to switch. So you end up with a dual operating environment, one where customers have common domain model implemented, and they might be your preferred destination while the others convert, or there might be a price differentiation, or might be a business differentiation flow in that direction to incentivize people to adopt standards if, and only if, we can prove that common domain model adds value. So that's probably enough from me. Now I'll hand over to John.
Yeah, thanks, Roy. And again, you made a very good point there, actually, about the need for having two parties to use something. Because what I've learned over the years is that when you're developing something internally, it doesn't really matter how good it is if it requires somebody else to also do something with your output. And I think that's kind of one of the reasons why this model, as we're describing it, and Julian will give us the real meat, is the first time, maybe the second time, because I think the first time we've really collaborated well is via SFTR. But this requires, not everybody, as you say, Roy, but it requires a huge amount of people to actually buy into this and agree on an operating model. Because without it, we're just going to end up doing it ourselves, and it won't be optimal, and we'll be back at square one. You introduced what I was going to talk about, a little bit of history, and I think it's apt to talk about, certainly for those that, of course, you all have read the first paper that we published back in July, sponsored by our good friends at Equilend, which talked about, the title of the paper was Building on the Past, and it really went through some of the history as to how the industry really kind of exploded around 1990, where you had a massive rise in hedge funds, and then accordingly, you ended up with a lot of prime brokers servicing them, which then ultimately attracted institutional investors who were then serviced by custodial banks mostly, but not entirely. And all of this ended up being very revenue generated. But if you were working in a support role at the time, you had to deal with all the mess that was left behind by poor booking, unreconciled transactions, And it became largely untenable for the industry to operate that way. You had failing transactions would lead to interest rate claims between each other. And, back in an environment that was higher interest rates, that was either lucrative or it was very expensive for you to do that. Then you ended up with disagreements over how to mark to market. No one really agreed on which prices to use. So you'd end up actually with problems to do with that process. Everyone knows that manufactured billing payments, manufactured coupon or dividends never get paid on their due date. Or if they do, good luck to you, because I've never seen one paid on time. And you end up reconciling that for months afterwards because no one actually bills each other the correct way. Although, again, there are tools now which weren't available back then, which have probably solved for some of that. But the biggest challenge is getting your books and records in line with that of your counterparties because, and I'm going to say unlike other industries, but that may not be fair, but I will say it, securities finance has movement of a transaction throughout its entire life cycle, its life of the loan. And there's so many things that adjust the record, that change it on a daily basis, that it's almost insane to try and think that you can keep that in synced with your counterparty without the use of some sort of external tool, which gave rise to Pierpoint in 2000, as we know, which solved for some of that problem, although some issues still persist between counterparties. And of course, the year later, the distribution issue, in terms of how do you move all these assets that are in great demand between participants, gave rise to Equilend. And as you say, Roy, Equilend has evolved since its 2001 to a very different platform that we have today. Back then, around the 2000 area, going into the 2000s, maybe even further, the credit crisis, the way to really solve for reconciliation issues or really infrastructure issues around how do we get these things to be more efficient was to literally throw bodies at the issue. And the problem with doing that is that it didn't really solve for the fundamental issue, but it was a cheaper option, as we all know, and that persisted for a while. And then it became very popular to offshore some of that activity. And during the paper research, when I interviewed a number of people, I found a common theme. That was they weren't very keen on the offshoring of operational support functions to remote locations. One of the comments I found that was consistent was that it gave rise to operational risks that they couldn't control well from their locations. And it also had actually led to quite high staff turnover over the years, which kind of defeated the object to some extent, because when they had to rehire, you ended up paying more for those people. Having said that, the tools to reconcile have improved over the years. But unless, as I mentioned earlier, unless it's a daily activity, it really defeats the object. And what I found also through the interviews I conducted, it was that the comment was made that it will go well with a counterparty, and then one of them will have a bad day. Something will blow up, that they're distracted by something, and then they don't actually perform the reconciliation that day, and you end up being out of sync. And so while you're put that fire, you never really catch up, and then the whole thing kind of falls apart. I think in the ISLA CDM webinar last week, there was a gentleman from Pierpoint that mentioned that 90% of breaks are still life cycle event related. So it's not the trade input that perhaps was a problem years ago. It's now more to do with the life cycle events. Moving on to where we are today, and why what we're about to talk about from Julian is really important, is that we've heard the use of the word standardization all of this year and last. And of course, it's obvious to all of us that unless we get some form of standardization into this, we're going to continue to exacerbate the issues that we have. I think SFTR was a great example of bringing some form of standardization to the market. But it was kind of more than that, because it actually was the first time that, albeit it's an external regulatory mandatory event that led us to that, to collaborate over SFTR, it's really, if you think about it, the output back to the regulators or to the trade repository is a common set of data. And if you can leverage that and bring the market together in a more collaborative way, then I think there's a very good ground base on which to build future consideration to a common model. So I think it's without question that the risk of not doing this is that we just keep on doing the same thing. Everyone knows that this market has been fairly plateaued in terms of revenue for the last couple of years. I hope that changes, but if it doesn't, you still are facing increasing operational costs, notwithstanding regulatory costs. And so you can't have both. So either you reduce your costs by, if you can't grow your business through revenue generation, you're going to have to crush your costs, but you can't do that either necessarily. Whilst I'm not going to address the costs of what all this is going to be, I think we have to start on the basis that this ultimately will pay back. And it also aligns the market very well for the next stage of evolution, which ultimately, I say ultimately, but wait till you read the next paper I'm about to release, or soon. Ultimately, it will lead to some kind of tokenization in the industry, but not before, in my opinion, not before the custody world does the same. So I think you need to see, I think securities finance will develop on the back of a revolution in terms of how tokenization will enter into the custody world, and then we will do the same. But you have to have some common standards to do that, and that's why CDM is absolutely vital to go to the next stage. So at the risk of going on, I'll hand it over to you, Roy, or to Julian.
Yeah, so let me actually just interject first of all to say hello to John, who's joined us again this week, and the unflappable David Schoen has also, after doing an excellent job at the showcase last week, has also commented that to your point, John, and that's precisely why the CDM focuses on encoding business processes and functionality of lifecycle events. So you have one event with the same input and the same output every time and looks the same to everyone. And you know what to expect, I guess.
Which is why in the example last week that they went through, it actually used the idea of allocating across different beneficial owners. If you think about how that operates now and how it gets out of whack, immediately you substitute internally within your system and don't tell your borrower. CDM will solve for that instantly. To me, the idea is that rather than post-trade services should be live trade services. And the more you get away from reconciliation into a record match within your operating structure throughout the day, you can eliminate a lot of these issues.
Yeah, I quite like that, John. What did you call it? Real time.
Well, I call it live trade services, but I'm sure I could think of a better acronym.
Trade processing. That's better than post trade. So that's great. Like we've talked, I talked really sort of 30,000 feet, John. I think you were more practical there in terms of what you were talking about. One of the questions I want to come back to you about later is the point on offshoring. And I'd be interested in your thoughts as to whether we've peaked in terms of offshoring. Are there other things that could go there, or have we reached the peak of it, or are there still other things to revisit? So maybe we can come back to that again. Julian,
Sure.
let's take it back to the practical side of the business, right? I said it has to solve problems, but what problems are you looking at? Are you thinking about in this respect?
Well, if I start with saying that you went on a 30,000 feet level, I think John descended to about 10,000 feet level, and now let me put my feet firm on the ground and let me talk what people face on a day-to-day business. And all we're talking about, securities lending, securities finance, all starts on the front office. There's a trader that executes something, and on the back of it, the entire process starts. But without being maybe a bit blunt, but traders are funny people, to be honest. They are only triggered by one thing, and that is to trade and to generate money. Everything else is a burden, and you don't want to burden traders because they get demotivated, they get angry. It's like not having your bacon sandwich on Friday morning. You don't want to speak to them before they had their coffee and their bacon sandwich. So if a trader executes a transaction, and on the back of it, he gets billing breaks, and he gets settlement issues, and he gets collateral management issues, he all those things will go back to the trader because he initiated that transaction, and ultimately he is the one that should know and knows what is the answer to the question that quite often comes out of the back office and the mid office. So in order to to maybe to keep the guys on the front office happy, you want to have a fully streamlined process on the back of it. And John mentioned things like Pyram helped already a lot. The electronic trading platforms through the guys from Equiland, of course, the FIS solutions. But ultimately, if there is a break somewhere, and you mentioned quite a lot of it is just because of the life cycle of the transaction, quite often it comes back to the front office, who then needs to solve that problem. And I think that's where, from a front office perspective, the common domain model is quite key to help them get a better day. But one of the things that is important as well is that all those issues that go back to the front office means that those guys don't do what they're good at. Is generating money, finding that new transaction, operating or finding opportunities, and that's the bottom line. Because the money has to come from somewhere, and the one that's making it should not be burdened with billing breaks and operational issues.
Yeah, and look, that's the example I gave about improving the STP. The reality is, what that did was that enabled the trader to spend more time looking at more complicated issues, to developing relationships, to finding better pricing, more accurate and more up-to-date stuff, and better negotiation. It all allowed them to kind of up their game doing the revenue generation, and that's got to be the test here. Also, Julian, we're going to come back to you after Julian, because you, based on what we talk about in the next few minutes, what we want to do is say, does that help answer any of the questions that you've kind of raised there? So I'm going to hand over now to our special guest. Actually, before I do that, I'll just leave. There you go. And now our special guest, Julian, over to you, sir.
Roy, gentlemen, thank you very much. So I think the message we've heard this morning is that securities finance has been around for a little while. Sorry, Roy. The processes, technologies, and the operating model stems from the early 1990s. In order to support that, I think that some of the vendor platforms hold their roots from that time. There are challenges around the flexibility. We know that some banks had challenges around SFTR, sorting the data attributes that needed to be reported to the regulator, because it just wasn't readily available. The data wasn't available within the systems and platforms. It was then challenging to source that, and created additional problems. We heard about SFTR and a question around timing. So is CDM Common Domain Model, is it right to look at it now? I spoke to ESMA before SFTR went live, and I asked a polite question to challenge that perhaps CDM should have been implemented before regulatory reporting happened, because you're suddenly trying today to put a standard-based reporting model on a data and process infrastructure which is different across every single bank, pretty much. Whereas if they had implemented CDM first, the industry would have got their data and processes aligned, and then reporting may have been slightly more straightforward. The regulatory agenda has clearly been a high-cost consumption of scarce resources, and now the business is focused on the business of making money. We heard from John that operations play a critical role. It's an end-to-end life cycle from trade initiation, managing the financial economic terms of the transaction. It would be best suited if it's identical between all counterparties. So when a trade is booked in the front office, exactly the same details, there's exactly the same data and exactly the same processes are applied to that transaction by both counterparties to the trade. This would then flow through the operations model, and it would significantly reduce the amount of effort that the back office needs to do in order to confirm the transaction, manage any cash movements associated with payments. There's a lot of benefits that CDM starts to bring to the operational model. Then to touch on Jeroen's point about the front office, there's been a long-standing trend really towards a golden source of data. So we want to avoid multiple touch points or enrichments of transactional data sets during their life cycle. And it would be hugely helpful if the front office is able to capture the trade at source in its perfect state, with all data attributes associated with that transaction and triggering any and all payment and cash flow events associated with that trade. The final obligation, I think, that sits on the front office is that they have to pay for everything. They have to pay for the systems. They have to pay for the staff. They have to pay for operations. And they're key stakeholders if they're looking to build a P&L, improve margins, reduce costs, and increase revenue. The front office is going to be motivated to look at techniques and solutions that will help allow organizations to do a better job. I have a few slides that I just thought I would share that start to highlight some of the areas of interest. And it's really a story about looking at impacts within the bank and external to the bank. So the data journey, and there's the enterprise data management groups within many banks who have been looking to provide a standard data platform. So data is a critical function. But what data tends to not take into account is the role of process. So if I've got a data item and I perform a life cycle event on that, that is a process challenge. The Common Domain Model seeks to bring together the data standards and the process standards. Standards is a key function. And we saw originally in the derivatives world that ISDA looked at potential challenges as a number of distributed ledger solutions were starting to arise in the derivatives market. So ISDA had a standardized best practice model, which was documented and defined, but it was a paper process. And the CDM codifies that. So this was the initial engagement that ISDA initiated to deliver a common domain model for derivatives. One of the benefits the derivatives had is that they had FPML, Financial Products Markup Language, which was effectively the data taxonomy for the industry. And that was a very good foundation for CDM to move forward from. Looking horizontally to adjacent markets, it's clear that stock, borrow, loan, and repo in the securities finance world have a lot of similarities with the derivatives world, not least some product crossover, to be able to deconstruct a transaction at a cash flow and payment level, and the ability or interest to standardize the data and process on an end-to-end basis. But in fact, the process starts with the sales operation and legal. So there is a KYC obligation, capturing source data such as SSIs and LEIs. And we heard last week that there are some ongoing challenges around the ongoing maintenance and support of LEIs. So these are critical data attributes that need to exist in a perfect state for the duration of the transaction lifecycle. New products. So as new markets come to on board into the securities finance world, legacy technology needs to be agile, and it needs to be able to model any new products that the front office needs and the clients need to transact. So it's important to have the ability to do this. Increasingly, risk play a critical function in the business, and there is a requirement to be able to compare like-for-like data across multiple products. That is a very complex challenge, and very few banks have been able to execute on this. But the Common Domain Model would help support the standardization and risk reporting of multiple products on a standardized basis. This potentially may have an impact on FRTB, for example. We heard from John about the operational risks, the fails, errors, exceptions, and the challenges and obligations around regulatory reporting. Technology remains a challenge. Is it truly multi-product? Is it agile enough to be able to onboard new products? Is it able to support the regulatory reporting requirements and obligations that the business has? The outcome really is that there are impacts on the client, excess time spent.
Julian, I think we're having some audio issues on your end at the moment.
Okay,
There we go.
right, I'm hoping that it'll tidy up. There's not much I can do. I have no additional processes running.
Yeah, it's all right. It's all right.
Okay.
Just to let you know. So yeah.
Right, understood. So this is really a very a schematic model of in-bank processes. So on the left-hand side, we have a rudimentary transaction life cycle from the sales through the front office. A transaction is made, affirmations, allocations. There are multiple systems. There are siloed legacy technologies. There are manual processes and duplicated systems across the product and scope. There's challenges for human-based processes where there's a dependency upon expertise to help resolve different solutions. Sorry about that. And then the back office systems are also challenged to support the multiple different products. That's the in-bank model. Outside of the bank, there are multiple touch points and transfer of data, both from a front office transactional point of view, where there are existing bank systems that are passing data through an API, or there is a requirement for a reconciliation process. This is clearly the start of the transaction. There's confirmation matching, there's different counterparty allocation requirements, there's relationships with market infrastructure providers such as clearinghouses and custodians, trade repositories and regulatory obligations, and then different settlement and payment functions, all of which have requirements for enriched data, different data formats, very limited data standardization. There are opportunities for error and cost to be in the bank during all of the transaction lifecycle journey touch points. The expensive technology costs means that there are multiple platforms and systems that need to be maintained. APIs and adapters need to be supported, and there is just a foundation of, or lack of a foundation of, a common standardized data and process model. So what are we going to do about this? Roy made a very good point that the business really does not want to be hit with another ginormous bill for enterprise transformation without really understanding the business benefit, the business case, and exactly how business benefits are going to be accrued. So any model that looks at any of these emerging technologies driving business transformation need to come from at least two different angles. The first angle is tactical, quick win, agile projects that deliver proven business value, ideally in year. And that will then sit into a more strategic framework of driving a digital foundation that helps the bank drive a more strategic, longer-term digital transformation journey founded upon standards-based processes and data. So there's a suggestion that banks need to understand what their current state is. And I don't mean what is my system, but really looking at a level of detail to where the largest challenges lie in the business. As mentioned, there are challenges around SSIs and LEIs. There are challenges around reconciliations and exception management. There are challenges with allocations. and then failed payments and settlements, the SSI challenge. So identifying a good starting point needs to be considered carefully, both within bank and across an industry. A challenge that the bank may have is that any bank adopting this model independently of the industry could do something that is unique and doesn't really deliver the value that is expected. So driving a standards-based journey where there is collaboration across the industry on a common challenge, allocations as an example, would clearly bring a convergent approach, achieve standardization, and embrace, or hopefully embrace, the market adopting CDM to achieve a specific problem. The benefits: reduce exceptions, as we've talked about, reduce exceptions, higher quality business processes, and it's definitely a quality-based story. And then looking towards future technologies and technology change over time. So step one may be to implement the common domain model and adapter, not changing any significant big step changes to existing technologies. But as we saw with the ISLA workshop and the ISLA proofs of concept, that the CDM adapter was able to standardize the data set across a number of the touch points, the front office booking model into Equiland, reconciliations and exceptions through Pyram, and the allocations model booked into FIS was what ISLA showed us. So these were three examples. It's early in the maturity cycle for common domain model, and there is a degree of change and evolution that will be taking place. But banks need to be up to speed on this so that they're able to participate and contribute to the conversation. And then on a longer term, more strategic basis, evolving the CDM model over time, looking at the different roles and responsibilities within the marketplace, the global standards-based approach that perhaps the trade associations best practice will be encapsulated by the trade associations, the technology evolution at a platform level from organizations like Regnosis, and they have been driving the core digitization of the CDM model through their Rosetta platform. And then how does this then impact emerging common domain model and distributed ledger databases and technical infrastructure? So on the one hand, we need to manage the risks for very high cost programs with more tactical, quick win strategic benefits. And there's a small plan about activities that banks could consider for 2021, subject to their budget, understanding who in the organization will be impacted, what are the product and scope. Process mining is a function which probably sits in the IT group already, but understanding the detailed transaction lifecycle journey, the touch points, the human interactions, really gives the business a window to drive the business case. Then how does the industry or the business go through planning, the analysis, the requirements, the scoping, the definition, looking at the impact areas in the event that CDM is deployed, preparing the business for change, looking at minimal viable product one, the design and build of that, perhaps leveraging some of the work that the ISLA Showcase has already done, then deploying it and trying to assess the actual benefits that were forecasted are actually then executed on. So I'm going to stop there. And really, I hope that the goal was to introduce some of the opportunities to look at how CDM will create value for the business. I hope my audio has been okay.
Thanks, Julian. I think your audio had that brief interlude, but has been fine as far as
it sounded like a dog barking, Roy. It probably was.
No, couldn't have been that. No live event would be complete without a dog, cat, or child entering into the program unplanned. So we had some great questions and comments. Let me welcome Saeed who from Regnosis, who was actually one of the presenters at the showcase last week, who's made a couple of great observations. John, can you give us some comments on Saeed's commentary in terms of talking about sort of the standardization and the customization and sort of the effect of that and on the business?
So I can't actually see Saeed's comment at the moment.
I can actually post these up.
But I think I see half of it, and I think what he's getting to the point is what is at the heart of really what CDM will represent, is in that we know that we have a current situation where we have so many moving parts to a transaction, which can last from anything from overnight to years. And unless both records are kept exactly in sync, every downstream process, as Jeroen has described and as Julian has pointed out, is subject to error or to falling over, and then requires all of the sort of repair work that has to go on. And therefore, to me, this is actually moving away from reconciliation completely into something that is absolutely live in terms of keeping your records straight. Now, I could be wrong about that, because I remember on the ISLA call last week, it was mentioned that even using a CDM process, some reconciliation will still need to take place, and we'll have to get onto that at some other point. But if you can fix, as Jeroen pointed out, if you fix the input the golden source for me is the record of the trade itself. If you can fix that by repairing any kind of error at the output almost instantly, because you're matching these two inputs to some other unit that will look at it, you're avoiding a lot of the downstream problems. So to me, for example, when I was researching the third paper that we're about to write in this series of 3 papers, I've been talking to participants from other industries. And the first thing that they say is that, oh, wow, securities finance, you guys are absolutely rife for both a common domain model and tokenization. And then they explain to me why. So I don't know if that really answers the question, but so it's absolutely right. This is a prerequisite to anything else we do in the future. And the risk of not doing it is more of the same. And then I don't know where you're going to stand from a revenue point of view.
Yeah. So, yeah, Julian, do you want to add on?
Yeah, I want to add a few things because John, you're absolutely right. So if from a front office perspective, there is a translation that party A and party B make sure that they enter into the same transactions and it will flow through. I think one of the points that Lee actually mentioned earlier, and I see Julian is back. That is of course the SBL transaction on itself is quite often not. It's not the case that the SBL transaction is on its own. There's flows on both sides of that transaction, whether or not it's on the hedge fund, whether or not it is on the cash equity side, the cash derivative side. So that chain of events is quite often broader than SBL. There could be a total return swap on the back of it, and all those things need to be aligned as well. So I'm not sure if Julian could pinpoint out where the common domain model is in relation to a chain of transactions.
Yeah, Julian, you back, and is your dog giving you control of your computer back? Apparently not.
Yeah.
I think great question from Lee, and just to expand on the reply from David Schoen, and again, I encourage you all to exchange messages amongst each other. But Julian, if you can hear me, then maybe I can relate Lee's question, because Lee basically said the common domain model makes sense, and you can see it for single plain vanilla products, right? Straightforward transactions, whether they're cash markets, securities lending, derivatives. But what about
Roy? I've got this.
I guess that's no luck then. So look, here's Lee's question. In terms of complexity and cross product, I suppose the value of common domain model is by having consistent definitions of what a life cycle event is. Then that same life cycle event, that same corporate action, and to use the example that that David has given, for example, there are a limited number of outcomes that can actually result from that. And the reality is whether that's as a result of just a straightforward cash equity market purchase or through a securities lending substitute compensation for a corporate event, or in a derivative contract in a cash settlement, the value that common domain model brings in is that any input that actually results in that event will produce the same output irrespective of the transaction. And that's also why, you see cooperation to an extent between the various trade associations participating, because there's value in all of us having the same definitions for the same event. But Lee, that's the challenge. And I think that's also where the greatest payback is, right? The reality is if you can find something that actually improves the process for multiple business lines of any firm, particularly on the bank or dealer side, the reality is that then shares that whatever cost there is out amongst the different groups. So if it's the derivatives group and the repo group and the securities lending group all have an interest, and it's all about common definitions, and you find that kind of lowest common denominator, that spreads out the cost organization, but also makes it a higher priority for the organization because it has multiple feedbacks.
Yeah, Roy, I think this is similar to a trend that we've seen, say, in the mid 2000s, that you saw a lot of the bank broker dealers merge their equity and their fixed income desks. Quite often, back in the 90s, there was a fixed income desk. You deal with them, and at the same bank, you were dealing with an equity financing desk, and they were not talking to each other, and they didn't even know who they were. But in the mid of the 2000s, all of a sudden they understand, well, it's the same product. It's the same collateralized product. We're dealing with the same clients. Maybe it makes sense to merge them together. And luckily, maybe not, maybe a prerequisite, but of course, with collateral costs spiraling out of control and having both collateralized products, you immediately found the synergies between the two desks. So I think this moves on and beyond what happened in the mid 2000s with regards to finding common ground in different product lines within a markets division at a bank.
Yeah, and Drew, and that's the same thing happened between the people that were servicing hedge fund clients for swaps and stock loan. Eventually, I think in probably almost every firm, but maybe not, where it's the same person now, because how a customer takes on a product really is more dependent on what agreements they have in place and which for any given transaction would be more appropriate. So I think that's a great example. Julian, and again, Lee, another great point. And I think, so Lee was talking about the different legal frameworks and the different jurisdictions and cross defaults. And that's why you see so many lawyers interested in common domain model, because they see the value in having common definitions, not only within an industry, but also cross industry. Julian, do you want to talk about this sort of this cross product, cross market integration?
Yes, so Roy, it's something that we've come across in a couple of banks in the conversations that we've had recently, and that is that the business case for using or adoption of common domain model is beneficial across a number of different product areas. So the groundwork that ISLA had done in the derivatives world would be very beneficial to join that together with any securities finance, stockbearer loan, or repo business that's looking at CDM as well. So one of the suggestions that we're making is that the banks converge their trade association membership groups in bank so that they can work with the business, work with technology to look at the optimal use case for CDM. And there's absolutely, as was demonstrated in the ISLA workshops, that there's a lot of the building blocks existing within the CDM as it stands today that is relevant and has value to stock bearer loan, for example.
Yeah, and as you say, this has been a constant theme in every single meeting that we've had on this topic, and so I think that's definitely an area of focus. Is everyone? We've got 4 minutes left.
Can I just comment, Roy, on that last point? And it carries on from the analogy that that Jeroen used. Whilst you, as you said at the opening, any kind of a big bang overnight approach is just because there's not enough data input for make decisions to spend huge amounts of money. But what Julian's suggesting is that, as Jeroen's analogies pointed out, that if you actually spread your vision further within your own organization, I think what you're saying is that you find areas that you can all collaborate with internally to then mutualize the cost internally, go externally. And that to me is something that there's two issues that I still want answers to that I don't have, which I think is a discussion, which is someone at some point is going to say, what's the cost? Show the benefit. I think the benefit is given, and you have to make the case for that. But it sounds to me that mutualization of other areas within your organization, which are already spending millions, if not billions, on data, on ideas that might produce something good for them. Here's a really solid case for doing that.
Yeah, and I think that's the point, John. I think one thing you said last week, and I think is a continuing theme, is banks want to invest in this area, but because of a dearth of ideas on what to do, they're often investing in external companies. Is that kind of what you're referring to?
Absolutely. When we publish our second paper, there's a reference to that, in that the amount of money that's been spent throwing money at fintechs without really solving for a problem specifically. So we've got issues. Show me what you can develop, which is maybe not the best use of funds. But more of that later.
Right. I was going to say we literally have 2 minutes left. But I want everyone to know that you should feel free to carry on putting comments into the box on LinkedIn. We'll carry on the conversation after this. If you put things in there, we will respond. But I was wondering if you guys could all do some maybe 30 seconds, literally, and I will cut you off if it's longer than that. 30 seconds wrap up on this particular topic. And I'm also interested from viewers, put in the chat any other ideas that you want us to talk about. We'll be back next Wednesday and every Wednesday after that, unless Christmas falls on a Wednesday, in which case probably only I'll be on. Julian, 30 seconds.
So my 30 seconds, Roy, would be to ensure that banks have got some budget allocated for a review of what CDM might mean for their business, whether that is across products to leverage the derivatives initiative, to look at repo and stock bearer loan, but to really start having a look at this to understand what impact it might have, and working with a neutral market representative organization such as Pierpoint and Eyre & Co would be a good first step, so that we can start to converge common thoughts and a common standardized approach to this, as that's going to be most cost effective.
Yeah, the only wrapper I'd put on that is the reason you think that they should allocate some budget to it is because you think there'll be payback within 2021. So put some money aside in 2021 and you'll get some value out of it in 2021, right?
Yes, that's dependent upon the use case, but there is definitely the possibility of that.
Yeah, cool. Thank you. Jeroen?
I would say any operational or burden that you can take away from the front office is immediate generating more money, because as soon as you free up time on the front office side, that person will go and find new transactions, find better spreads, find new clients, find new counterparts. It all makes perfect sense, but hey, it's a bit of a pain to get there probably.
Well, look, as Saeed and David both pointed out in their comments, there is direct and observable value out of having single records that aren't in dispute at the trading level. John, I'll give the last word to you before I wrap up.
So my advice would be, don't blow this as another thing. Take it seriously, because it is going to happen with or without you. And it's better with you, because if the industry needs to collaborate on this one, this isn't a commercial distinction between an advantage, disadvantage. It's going to happen, and it's better that it happens within the wider framework of securities finance than having an external huge organization come and do it for you that may not be quite how you want it to happen. So, or how we want it to look. So ask questions. We haven't answered every question here. We couldn't, but take this one seriously into 21, because it's important.
Great, thanks for that. So listen, I believe that my whole career has been one long digital transformation, and I see this just as the latest step in making the business better. I'm going to be participating this afternoon in an event put on by FIS, and there it's about sort of the business, about the future of the business and the revenue opportunities. This very much is part of that. So I'm sure there'll be more discussion on that. They've put on some challenging questions, which hopefully I and the other panelists will have answers to. But thanks again. Join us every week on Wednesdays. Send us ideas on what you'd like to see us cover. Hope you enjoyed it. Thanks for your really active participation, a lot of feedback and comments again. And thanks for watching, whether you're watching live or watching on the replay. That's a wrap. And that's another Securities Lending Live with Pierpoint. Thanks again. Bye.
Thank you.
Bye.